So let's talk more about the setup as we now, believe it or not, head into the second half of the year following a great and epic first 6 months. Let's bring in David Spika, Chief Market Strategist at Turtle Creek Wealth Advisors. All right, who's going to be the turtle? Who's the rabbit, David, for the back half?
Well, you're right, Kelly. It's been a very strong first half. If you told me at the beginning of the year, when expectations were for 6 rate cuts and that we would get through the middle of the year with no rate cuts and that expectation falling to 1, there's no way I would have said we'll be up 15%. So the key has been earnings growth. That has been the key, and that's very good to see. Historically, earnings do drive the market and fundamentals drive the market. But what we've seen since 2008, it's been monetary policy. And I feel like we've gotten way too dependent on monetary policy. So earnings growth is driving it this year. Earnings are outperforming non-earners for the first time since 2021. And in the second half, I think that continues. And there's a lot of tailwinds for this market that I think will continue to drive stocks higher.
Tailwinds like?
Well, tailwinds like liquidity, Tyler. We've seen deficits increase for the U.S. government, so they're going to have to issue more treasuries. So that increases liquidity. That'll be positive. The market generally responds well after a presidential election, so we're likely to see a rally in the fourth quarter. And the disinflationary traction continues. You mentioned the PCE data. The disinflationary momentum continues, and we're likely to see a Fed rate cut in the second half. All that bodes well for stocks.
So soft landing, rising stocks.
Absolutely. And again, the beginning of the year, that was a tough bet. But where we are today, given how strong the economy continues to be and inflation continuing to fall, that's a very much a likely scenario. And that's good for earnings growth. That's good for stock prices. And quite frankly, don't overlook bonds. With rates continuing to be at an elevated level relative to where we've been over the past 15 years, investors can do very well in the bond market today.
What happens to NVIDIA? Second half like the first?
Well, you've seen NVIDIA trail off a little bit. I think the valuation got a little ahead of itself. But one of the things that really has been the key for NVIDIA has been earnings growth. It's been AI and the exposure to AI and that tremendous earnings growth that NVIDIA's seen. I would rather own other companies that can benefit for the same trends, like a Broadcom, that is trading at a much more reasonable valuation. Broadcom's trading at about 25 times next year's earnings, still going to grow 15 to 20%, has that exposure to AI. I think that's a better place to be than a company like NVIDIA that I think accounted for about 35% of first half gains. There's other things you can do to benefit from AI, but I wouldn't put it past NVIDIA continuing to go higher. I mean, that's a bet I don't want to make at this point.
You also like consumer discretionary. Give me some examples.
Well, one of the names we like, Tyler, is Costco. Now, admittedly, trading at a very premium valuation. But think about where the consumer is today. Inflationary prices are still hurting the consumer. They need to be able to shop someplace where they can get a good value. Costco is that place. I can tell you for a fact, my 93-year-old father shops no place else, and he is very much a value buyer.